Adrian, thank you very much for specially flying in from Hong Kong to celebrate CNBC-TV18's 19th birthday.
Well, I feel I talk to you more often than my own 19-year-old.
Feels the same, right? Thank you so much.
Our feelings are mutual. But what is your fondest...
19-year-old son, Adrian, good morning.
Yes, I've got a 19-year-old son. Yeah.
Oh, wow.
Okay, what is your fondest...
And a 22-year-old daughter as well. So.
Oh, an older daughter as well?
Yeah.
Okay, well. What is your fondest memory of the past many years that you've interacted with us?
Well, I mean, I was reflecting last night. It was an event with Lata where it's 25 years since FIIs came into the market. So when I arrived in '93, there was very little information at all about the stock markets, let alone having TV news channels. Yeah. But it's always been very fun interacting with CNBC because, you know, the depth of coverage that you get on business news in India is much better than I've seen in any other emerging market. And you're competing in a very competitive space as well. So there's sort of the resources, the people you bring on. But what I've always enjoyed is how, you know, you build these segments together with CEOs of companies, some senior ministers, etc. And, you know, there's a continuity through the show. So congratulations, happy birthday.
Thank you so
Adrian,
much.
and it's really impressive. You're the only one who remembers that this is the 25th year of FII investments in India. We started in like '94,
yeah.
So it is the 25th year.
Back then, in August '93, there was $69 billion was the market cap, rather than $2 trillion for the BSE now.
Yeah,
do you know how many cars on average were sold back then? It was 12,000 a month in the whole of India. If you look at the passenger vehicle numbers.
It was 12,000 a month.
Wow.
Well, what was your choice? You had an ambassador from Hindustan Motor, or Premier Auto would sell you a Fiat.
Fiat, yes. And then the 800 came in from Maruti.
Well, yes. Yeah. Well, actually, Maruti was back in the mid-'80s. I remember I drove a Maruti Suzuki back in '85 when I was living in Pune.
Oh, that's
and
nice.
That was, and they were very difficult to get. There was a huge long waiting list.
You know what? And exactly. And Bajaj Auto Scooter or the cylinder of Indian Oil. But anyway, and of course, those are the times when the market would move 50 points in a matter of entire month. Now we do that in a matter of 3 or 4 minutes. But you know, since
it couldn't do that. So I'll tell you a story. We were running this India fund, and it was quite big. It was $100 million, and our average unit size was about 1.2 million. But this was a smaller company, so I bought $1 million worth. What I didn't think through was the board lot was $5. So you had a share certificate, and you had 2 other documents with it. So I turned HSBC into a logistics business because they had to move 600,000 pieces of paper and then process them. So the reason the market didn't move very quickly was every time you did a transaction, the paperwork you would generate would be extraordinary. And it wasn't unusual for it to be 6 months before you actually had deliverable securities again.
You know, these anecdotes are amazing. I mean, when you talk about 12,000 cars a month, now the company that has the least market share sells more than 12,000 cars perhaps a day, you know, so that's the kind of market that we've evolved into. You've been here, you've seen this market evolve so many years. What's the next big trend according to you?
So I think there's a lot is going to change, and there's been some very important policy implementation. So this Insolvency Act, I think, is very important. And remember that the issue with an Insolvency Act is the legislation is very good, but then you need the soft parts, which is experienced judges, lawyers, accountants. But once you get that in place and people build confidence with that, then I think the financial system will get even more sophisticated. And the type of funding that you'll see in place from the private equity markets, you know, the ability to fund perhaps some of the renewables that'll be very important for providing power for this country. So I think there are some significant changes that come out of reforms that have happened over the last couple of years.
Okay. Adrian, since you spoke about the first time the FI investment came in, let's talk about that now. Some sign that the FI money might be coming back after a long hiatus. Is that the right way to read it?
Yes, I think this was an extraordinary year, 2018. You had US interest rates moving up quickly, and there was a lot of confidence that they would keep on moving up until about 4 or 5 weeks ago. And so the interest rate differential between the dollar and the euro built very rapidly to nearly 3%. There's no interest rate differential between the renminbi and the dollar. So you've got a very strong dollar, a flow into dollar assets, particularly fixed income. And then for the equity market, the earnings growth in the US was nearly 24% at its peak, so the EPS year-over-year growth, whereas in EM it was just under 10% and being revised down. So the risk assets all went to the US. Now, as we look at 2019, I think that is changing. So the interest rate expectations are being moderated for the US, and we have long bond yields dropping well below 3, which is just amazing considering where we were in September. And so I think dollar strength has come to an end. You get a rebound in EMFX, pressure on EM money markets, liquidity situation eases. That gives you a leveraged effect. So when your currency is weak, interest rates tend to go up, monetary conditions tighten, confidence in growth goes down, P multiples derate. We go through the opposite in 2019. So I think there's a flow of capital into EM, and India will benefit from that. Whether India gets its share, more than its share, or less than its share, is a function of what happens with the trade dispute between China and the US, and whether the Chinese economy is deemed to be improving. If you get those two conditions, then I think disproportionate amount of capital flow will go into North Asia, Korea, Taiwan, and China. If you don't, then India will get more than its share of the flow into EM.
And your bet is that a deal will be struck and tariffs won't go to 25%?
Yes, that's my bet. But big caveat, predicting what President Trump will do is not a very smart thing to do. What I would reflect on was that the pace at which NAFTA was renegotiated, the fact that the Americans came to an agreement with the Mexican government, particularly the future president, President AMLO, was quite surprising. Remember, they did come to a deal with the Europeans. I also would like to make a point that we're in a world where there's a lot more free trade, not less free trade. There's a very significant free trade agreements between Europe and Canada, Europe, Mexico, Europe, Australia, Europe, Japan. So those, Japan is still the world's third largest economy. So the world is moving much more in the direction of free trade. The outlier is President Trump and Navarro, Lighthouser, etc. That's the outlier.
So with respect to India, you did mention that the Insolvency Act has been a very important development, and you said there was some more significant reforms. From a foreign investor's standpoint, what else has India been doing right? Okay,
so GST, at the moment, GST, maybe the media around it is slightly more negative. It's another bit of paperwork. No one likes taxes, etc. But GST is about creating a free trade zone in India. This is about making a factory in India address nearly a $3 trillion economy, $3 trillion US dollar economy, rather than addressing a state economy and then having to deal with octroi, etc. So I think we're underappreciating the importance of that. And that's a very big efficiency gain. I think that makes India a much more attractive place for foreign direct investment. And so these types of reforms, we tend in capital markets to think, well, immediately I need to discount that. But these are structural reforms. These take many years to play out. And you look back on them and you realize how important they were.
You told us earlier that, in your pecking order, at the moment, assuming that a trade is, peace is struck between US and China, China is your best bet in the emerging markets. What would you buy at all in India?
So for me as a strategist, I'm struggling a little bit with India in terms of developing a strategy. So if we think about this year it was to buy exporters, right? Weakening currency. And to some extent, there was playing energy names as well. All those have to reverse now. So you want to get more domestic. But what we need to be conscious about, where is your domestic market capitalization? Okay. So we have the banking system, we have the NBFCs, but that to me is incredibly stock specific, right? There are a whole series of events going on there. You know, today you could have at the beginning of this year said, I should be long banks. Yeah. But if you're long HDFC Bank, you're probably quite happy. If you're long Yes Bank, you're not happy. Yeah. You know, Bajaj Finance is doing quite well as an NBFC. But being asked a general question as a strategist, should you buy NBFCs? My answer to that would be very carefully, if at all. So I think India, from a strategy perspective, is a difficult one to say is going to outperform in 2019. Let's also remember, even with the moves we saw in markets, the Nifty is up barely year to date, but it is up. It's not down 20% like Shanghai is, etc. So I want a bit of a domestic bias, but I'm struggling a little bit to put that together. Maybe some two-wheelers. Yeah. It's not necessarily that you're going to go aggressively into FMCGs, because you probably don't want too much of a defensive bias here if the interest rate outlook is looking more favorable than it was. So the market composition is a little bit frustrating for when you want to get a bit more cyclical.
The only issue is some of these names like Lever perhaps have not been, have not shown defensive characteristics. They have been the biggest wealth creators over the last 12 months, 1 year, and they've done well in all markets. I mean, consumption pieces that you don't want to be too defensive, but names like Hindustan Unilever in India, or say United Spirits, or a Jubilant Foodworks, the absolute consumption story, you want to buy that?
So if we think about, do I want to get a bit more of a cyclical bias? The answer is yes, because the outlook was going to be that the RBI would raise rates a bit more. That's all been modified, hasn't it? We've revised down the inflation forecasts. And so I'm looking for a slightly more cyclical exposure. And classically, I wouldn't go and buy a fast-moving consumer goods company if that was the situation. The other thing we need to be conscious here is, although this move in interest rates might be good for industrial investment, it might be good for the urban consumer, the data on the rural consumer has been a little bit disappointing. And I think when we look at the most recent GDP numbers, that's what was coming out. And near term, I don't see an obvious driver for why rural incomes will accelerate in 19. The moves that we're talking about in interest rates and oil will tend to favor urban and tend to favor the industrial sector rather than the consumer sector.
Already,
which might mean we get a little bit more into some mid-cap names where you might get more of your cyclical exposure. And with the route that we've seen in markets, that perhaps is where the value is.